Hedgebook has been designed as an easy-to-use system to help treasury and finance teams manage their foreign exchange risk and at the same time give their trusted partners, such as their bank and FX broker, oversight of their foreign exchange risk position. Why do banks and brokers want to use Hedgebook? Banks and brokers are giving their customers access to Hedgebook to help them manage their FX risk. Hedgebook is an alternative to error-prone spreadsheets for recording deal information, provides independent and daily mark-to-market for open transactions. The valuations can be used to streamline year-end compliance of financial reporting. It is a single repository for capturing deals across all of the customer's counterparties. It is a tool to increase customer loyalty. It is a practical example of banks and brokers' digital strategy. It gives access to customer data that the bank or broker otherwise would not have. Sales teams can build strategies to help customers with FX risk management. It includes scenario testing to help customers with complex analytics to understand risk positions. It provides greater visibility of a customer's FX exposure, enabling the bank or broker to develop appropriate risk mitigation strategies and foster a closer relationship with the customer. Hedgebook generates data-driven insights and leads to targeted selling of appropriate FX hedging products. The focus of this video is to show how Hedgebook helps sales teams engage with their customers with a specific focus on FX risk management. It discusses the data already captured, the data that you need to extract from your customer, and the synergies that Hedgebook provides when combining this data together. Hedgebook is a powerful tool to enable you to engage with your customers and deepen your understanding of their business. Getting to know your customer and their goals ultimately leads to greater deal flow and, where appropriate, selling higher margin financial products such as options. Additionally, your customers will be stickier and happier. To get the most out of Hedgebook, there are a few data items that are critical. Current FX hedges. Deals transacted by a customer with your organization are loaded automatically daily. Relevant staff and every customer that has a profile on Hedgebook can log in and see all current and past deals that have been transacted with their bank or broker. New spot deals, forwards, swaps and options are all updated daily. Neither the customer nor the sales team has to do anything further on this front. Hedgebook is always up to date and through the exposure tool displays the net hedging position. Note that any deals that have been transacted by the customer with other banks or brokers will need to be loaded into the system. This can be done by the customer themselves, supported by the bank or broker, and Hedgebook staff. There are inbuilt tools within the Hedgebook system to allow for the quick bulk upload of deals. The counterparty can be masked if the customer has concerns about making this visible. However, in our experience, customers are less concerned about this than you might think. Why do we need other counterparty data and why should the customer provide it? There are two key reasons. Hedgebook provides a common data source for the mark-to-market for all deals irrespective of counterparty, so the customer does not have to source valuations from multiple providers. A real value add at year-end reporting time. More importantly, from a risk management point of view, the sales team is much better informed regarding the customer's complete FX hedge position and can, therefore, confidently provide accurate and tailored FX hedging strategies. Foreign currency cash flows. To engage with customers around their hedging requirements in a meaningful way requires the FX sales team to understand the currency, direction, and amount of the foreign currency exposure. You likely already know the currency and direction. The amount can be split into two components. There's the known cash flows, likely the short-term 1 to 2 months ahead invoices. And then there's the unknown or forecasted cash flows. These are the longer-term 3, 6, 12 months plus exposures. Naturally, there is uncertainty regarding what these might be, as with any forecasting. However, many customers will be running spreadsheets that have these forecasts in them. For example, a euro importer will forecast the euro spend over a future period of time. It may be based on euro spend in previous months and years, adjusted for factors such as business growth, economic conditions, raw materials, etc. The point is, these forecasts likely exist. And if they don't, it's a great way to engage with your customer and help them understand the importance of making these forecasts. Yes, they will change on a regular basis, but making forecasts and regularly reviewing and updating is key to the art of robust FX risk management. Hedgebook makes it really easy to capture these forecasts. Budget rates. Most customers will have a budget rate that they are working towards. Whether it's a costing rate for overseas purchases or an exchange rate used for pricing goods sold overseas, the customer likely has a budget rate. The weighted average rate of hedging already in place may be combined along with prevailing market rates to set the budget rate. Hedgebook provides the weighted average hedged rate of existing hedging, which can feed into the setting of the budget rate. The budget rate is an important metric when working with customers to formulate a hedging strategy. Meeting or beating the budget rate is often vitally important for a customer's ongoing success. Treasury policy and FX risk control limits. Depending on the size of your customer, often the board of directors would approve a treasury policy and give senior management the authority to act within it. The only time senior management would go back to the board would be if they wanted to do something that was outside of the policy. The policy will have minimum and maximum risk control limits that change over different time horizons. For example, foreign currency cash flows in the nearer dates, such as the next 3 months, can be hedged to a higher percentage than forecasts further out. The reason is the greater certainty of the cash flows in the nearer dates. When treasury policy limits are added to Hedgebook, the FX sales team can monitor the amount of hedging in place and suggest FX strategies that comply with the limits while cognizant of the expected direction of FX rates. If the FX rate is expected to improve, then keeping hedging toward policy minimums makes sense, whilst if the FX rate is expected to move against the customer, then having hedging limits towards policy maximums is the better strategy. This is an example of active FX risk management. If a customer does not have a treasury policy or risk control limits, then the bank or broker is able to provide some guidance in this area, displaying further treasury expertise and building a deeper and stronger relationship with the customer. The foreign currency cash flows, budget rates, and treasury policy risk control limits can all be captured in Hedgebook and used to drive valuable FX hedging strategies and conversations with the customer. Building trust with the customer, delivering value to the customer, and driving revenue from the customer. Moving to a more collaborative way of customer engagement requires sales teams to display a deeper knowledge of corporate risk management. It is not only about understanding the machinations of FX markets, the economic drivers, the upcoming macro events and geopolitical landscape, that's a given. You also need to understand the requirements of the customer's finance team. Put yourself in their shoes. Hedgebook facilitates this. You need to understand why the budget rate, forecasted cash flows, and treasury risk control limits are important parameters, thus encouraging the customer to share this information. In the following demo, we have a GBP Euro importer, and we already have cash flow forecasts, a budget rate, and treasury policy limits to work with. All of this data is visualized using Hedgebook's exposure tool. So, as a FX salesperson, how can this information be used to form a hedging strategy and present it to a customer? Well, there are some key steps to take. First of all, we need the current hedging position. We need to have confidence in our starting position. The exposure tool can distill a lot of information into one key visual. Here we can see the aggregated monthly amount of hedging in place along with the weighted average hedged rate. In the case of options, Hedgebook considers the prevailing market rate against the strike rates of the option and applies the relevant rate. We also have the forecasted foreign currency cash flows, budget rate, prevailing market rates, and indicative achievable rate all represented in one chart. The achievable rate is the weighted average hedged rate when current hedging is combined with the unhedged component of the forecasted cash flow at the market or scenario rate so that the forecasted cash flow is covered 100%. When presenting a hedging strategy or trade idea to a customer, we need to articulate the problem that we are trying to resolve. Examples are underhedged and exposed to adverse movements in exchange rates, or securing or beating the budget rate, or perhaps a breach of Treasury policy limits. All of these are great reasons to present a trade idea to the customer and displays a proactive approach. Next, we need to quantify the risk. Hedgebook's analytics enables the sales team to demonstrate to the customer the hedging risk position. We can use the budget rate, if there is one, to measure against. If there is no budget rate, we can use the prevailing market as our starting point to quantify the impact of movements in exchange rates. This is a fantastic way to highlight the customer's risk position and emphasize the P&L impact from movements in exchange rates. By using the FX rate sensitivity slider, alternative exchange rate scenarios can be considered. We can approximate the bank or broker's forecast, as well as risks to the view. The slider changes the market rates used in the exposure tool with the corresponding impacts on the hedged rate and the achievable rate. Any structured option outcomes are recalibrated based on the hypothetical exchange rate scenario. With the exposure tool, we can quickly and in a visually compelling way demonstrate to the customer how the current hedging position will be impacted from movements in exchange rates and show what this means from a budget and a Treasury policy perspective. Having established the current position and demonstrated the impacts of exchange rate movements, we are now able to explore possible trade ideas. In this example, we're going to use fixed forwards and leveraged collars. For this demo, I have pre-populated months 7 to 12 with a total of 1.875 million euros of forwards, which represents 50% of the forecasted cash flows. I have used prevailing market forward rates. You can see the hedged rate, achievable rate, and market rate overlap. But once I start moving the sensitivity slider, we can see these rates diverging. For example, a 5% weakening of GBP means the hedged rate when buying euros is better than the market rate, resulting in a positive P&L impact compared to the no new hedging approach. We can toggle trade ideas off and on to see the impact. The protection against the weaker GBP has changed the negative £225,000 position against the budget rate to negative £137,000 when we include the trade idea. The customer is protected from the weaker sterling. Of course, the opposite is also true, by which I mean if there is a subsequent weakening of euro versus sterling, then the trade idea has limited the participation in that movement. A 5% weakening of the euro results in a positive P&L impact, including the trade idea, of £173,000 versus £252,000 without it. Effective risk management is not all about being on the right side of future exchange rate movements. It's well understood that nobody has a crystal ball. Reducing the P&L volatility from exchange rate movements is also a key component of hedging. We can also see that from a policy compliance perspective, we have moved from an outside of policy position to an inside policy position due to the additional 1.875 million euros of hedging in the Feb 24 to July 24 bucket. Prior to the trade idea, the 0% of hedging was below the 50% minimum risk control limit. When the trade ideas are included, we move to 50% hedged, achieving policy compliance. Hedgebook has other hedging products available as trade ideas. For example, we can replace one of the forwards with a 2-for-1 leveraged collar and see how that structure performs under various hypothetical exchange rate scenarios. Once you are happy with the trade idea, the various charts and tables can be snipped and sent to the customer for review, discussion, and ultimately execution of the transactions. You will no doubt have your own way of engaging with your customers and presenting FX hedging strategies, such as via email or as part of face-to-face meetings, PowerPoint presentations, etc. Over time, as confidence grows, using Hedgebook's exposure tool live with customers becomes easy too. However you do it, the Hedgebook-derived information enhances your data-driven, well-considered pitch with a strong call to action for your customer. Hedgebook is efficient and effective at helping you compile and share FX hedging strategies with your customers. If you have any questions or comments about the content of this video or any other aspects of Hedgebook, please get in touch.